Howdy, lieutenants and economists.
The most volatile, evil, disgusting things on the planet, humans. If you have a video request, you can always go to assholeconsulting.com.
Yeah, I am gonna charge you, kids. And that is the importance of not fucking up.
You are such an asshole!
Hey everyone, have quite an interesting video request, and I decided to go beyond what I put more time into this than I did what I charge, because I think it's a very important lesson for everybody to have, and that is, what exactly is quantitative easing? What does it mean for the rest of us? And so I, with my super awesome economic genius trademark, will explain, but I'll splice a couple charts and all that in here. As you know, I'm not exactly terribly couth with the multimedia stuff, so it'll just listen to the message, okay? Hey Aaron, I'm not familiar with quantitative easing and what it does. Please do a video explaining this and all negative effects it has. It could have positive effects. What are you so prejudging already? What? You don't like the quantitative easing? Why not? What it do to you? That's racist. That's racist. Ah, quarter Jew, technically. Yeah. Maybe I'll do the whole thing like this. I don't know. Herschel, why are we talking about quantitative easing? I don't know. Did you want to talk? Who wants to do the talk, hey? Please start at the basics. Give the dummies version. Much appreciated, Adam. Please feel free to throw in some of your old guy into imitation. Hey, we could do the old guy and the Jewish guy. What? No, wait, that is an old and Jewish guy. Hey, I can't hear, take everything. What? Why can't you hear? Do you have something wrong with your ears? I was a damn good economics teacher. Everyone loved my class. I'll tell you that. I made it interesting. All right, let's get to this. I took a couple notes and for sake of clarity. Now, to understand quantitative easing, we have to understand why it came into existence, and so we need to know the difference between fiscal policy and monetary policy. There are, in general, two entities in the government that want to help the economy grow, in theory. One is the federal government, and the other is the Federal Reserve. They are two separate entities. I won't go into the boring details, but the federal government determines largely tax and spending. And so what it can do is it can lower its taxes and increase its spending to help get the economy growing. So people know, government programs, that's what FDR did back in the Great Recession or Great Depression days. He lowered taxes, raised spending, and we're doing the same thing here today. We lowered taxes, have spending, we're running deficits. Now that's called fiscal policy, okay? So that is in charge, that's the domain of the federal government. The Federal Reserve, again, not part of the federal government, they control monetary policy, monetary being the base for or meaning of money. It controls the money supply and all things money, okay? So in that case, the Federal Reserve has three main tools that it uses. And this is how you get killed in a Quentin Tarantino movie by Nazis, because they said 3 more beers. So if anyone... What was the name of that movie? That one? Inglourious Bastards. 3 more. Try more. Okay. So Federal Reserve's got 3 tools that it uses under its monetary policy, generally. There is the federal funds rate, or quote, the interest rates. This is the rate at which the federal government lends money to the banks. A little more complicated than that, but we're going to leave it at that simple explanation. Obviously, the lower the interest rate, then more banks borrow more money. They then lower their interest rate, in which they pass it on to their consumers and their customers and their borrowers, and then they might borrow more and invest in a whole brand new $2 billion plan, because short-term interest rates were down 0.25%. Okay, that's the whole point of the interest rate there. The reserve requirement ratio, this is the amount of money, because we have what's called a fractional reserve banking system. That means if I deposit $1,000 with the bank does not hold on to my $1,000 for me. Instead, it lends it out. It may not lend it all out. It has to keep a little bit on deposit in the vaults, in case some people might want to make some withdrawals. And the only way you can get away with fractional reserve banking is because not everybody comes to the bank and withdraws some money at the same time. They put it in the bank for safekeeping, just to hold it. So the bank's got all this capital. Say, hey, what should I do with it? Well, let's lend it out and make some money. There's no point letting it sit here, collect dust. So we pay these people, the depositors, about 2%. We lend it out at 4 or 5%. We make some money that way. And that's basically how banking works. So it is a fractional reserve, a fractional deposit system. And I forget what the reserve requirement ratio is. It used to be 8%. Maybe they've increased it to 12. I don't know. I'd have to look this up again. But let's just say it's 10%, okay? Well, the Federal Reserve determines that. It says, no, all you banks, you have to have 10% of your deposits in there. And this also then affects, indirectly, money supply. Because if the reserve requirement ratio is, say, 50%, you got to keep half your money there. Well, that's not a lot of money floating around. There's not a lot of money left to be lent out. But if it's down to 10%, you can lend out 9 out of every $10. Well, that's a lot of money that can be lent out. So that money then circulates into the economy and, in theory, helps boom business, and people borrow and invest, and they all start sports bars, and they all start trinket shops, and that's the GDP of the world economy, or the U.S. economy today. We don't actually build things here. I want to start a kitten store, a kitten clothing store. I'm an entrepreneur. My hubby lent me the money. Had plenty of those in my banking days. So that's the second thing. And then the third thing is the money supply, which is I like to call FOMO, which means Federal Open Market Operations. And I like to call it FOMO because it sounds more fun. But all that means is the money supply. And how they control the money supply is through government security, so it's a little bit different. It's not like the Federal Reserve just prints off money and puts a block of it out in the street and then people fight over it. They introduce it into the banking system and financial institution system. And how that works is, let's say the Federal Reserve wants to increase the money supply. What the Federal Reserve will do is it will print off money or take money that it has on hand, and it will buy, typically, or historically used to buy, U.S. government securities, U.S. government savings bonds, U.S. bonds, treasury bills, the very low risk, low yield, very safe government bonds. So they would go to Morgan Stanley, they go to all these other banks, they go buy it up, and what would end up happening is the Federal Reserve, the money's sitting at the Federal Reserve. You saw Die Hard 2, kind of like that? It's just sitting there, it ain't in the economy, it ain't doing nothing. But once they sell it, they take the treasury bonds, they hold it now in the Federal Reserve vaults. Again, I'm making this simple. And then they throw that money in the economy. Now the money supply has gone up. And they can do the reverse. If all of a sudden they want to decrease the money supply, what they do is they take their assets, they're predominantly, historically speaking, what was government bonds, and then they put those up for sale. And then the different financial institutions and investors would say, I want to buy some bonds. So they then give the money to the Federal Reserve. The Federal Reserve gives the banking system or the purchasers the bonds. Bonds are technically not money. You don't trade them with people for goods. And then that money comes into the Federal Reserve and it sits there and no one else can use it. And that lowers the money supply. So these three tools are used to achieve two general purposes and things. One, to keep inflation in check, keep prices stable, which they have failed miserably at over the course of time. And then two, to help boost the economy. Now, I'm not going to argue whether or not it's effective. Monetary policy has proven not to be effective. I mean, it can prove detrimental. It can certainly hurt, but usually it doesn't. There's very little help that goes on in the real economy. But that is what academians, Keynesians, and stupid government bureaucrats actually think. So that's what it does. Now, enter in the great financial crisis. And you would say, well, what is quantitative easing? Well, quantitative easing is basically FOMO. It's Federal Open Market Operations where they're affecting the money supply. However, whereas FOMO was strictly relegated to the purchase and sale of quality U.S. treasuries and savings and bonds and stuff like that, quantitative easing was basically FOMO, but now, instead of buying quality government savings bonds, we're going to buy all the shit out there, get it out of the banking system, and then put it in the Federal Reserve. And you say, well, what do you mean shit? Well, remember all those mortgages the banks made, and then they kind of collateralized them together and made collateralized debt obligation and mortgage-backed securities, and they would package them, and then, does any of that sound familiar? And then they trade among each other, and Goldman Sachs was really smart, and all these big-time Ivy League brilliant geniuses like Dick Fuld, and they just say, hey, we threw in some quality mortgages with the shitty ones and the whole subprime thing, and they all got repackaged together into mortgage-backed securities or asset-backed securities. Yeah, those didn't turn out too good, did they? Okay, so here's the problem. the financial crisis is coming, if not, it's in full force. And it's threatening the entire banking industry. Lehman Brothers had filed for bankruptcy. This is what they're having those emergency meetings about. And they said, holy shit, these elite, really intelligent investment bankers and bankers made such stupid, fucktacularly stupid fucking loans on orders of trillions of dollars. It is going to literally threaten our entire financial system. And that's a bad thing. And you say, well, why is that a bad thing here? Well, because your financial system is like your circulatory system. I did a post not too long ago about this. And it's kind of like having a heart attack. Like, if your blood doesn't flow through you, you're kind of fucked. And it's the same thing with the economy. If your money doesn't flow through the economy, you're kind of fucked. And they were saying, we got to head this off at the pass, so what are we going to do? And so what we're going to do is we're going to help boost the economy, because nobody's investing, nobody's saving, and we're going to give these banks money. We're basically going to buy their shitty assets that they own, these mortgage-backed securities and all that. We're going to recapitalize them, meaning we're going to, their banks are suffering losses. And so how do you pare your losses, or how do you prevent from going bankrupt, wherein you have more liabilities than you do assets? The Federal Reserve Bank said, we will buy those nasty, dirty mortgage-backed securities, asset-backed securities, collateralized debt obligations, all those bad mortgages and loans that you made. We're going to buy them off your hands, so we will collect the payments from the deadbeat people you lent it to, and your cronies and your assholes and your parents and all the other dickwipes you all lent the money to. We will collect the money from them, and then we're going to give you this cash, and that will, one, stabilize the banking system, and then two, lower interest rates as well. You know, money supply is increasing. Banks will lend out more money, and let's get that economy going again. And because interest rates is all that drives the economy. Interest rates, never mind fucking future or anything like that. And then so lower interest rates, and then also it would stabilize the financial system. Banks would not be on the verge of closing. Circulatory system of the economy would keep running, and crisis would be averted, and we would not have what would have effectively been the world's worst in the history of the world and largest in the history of the world's bank run and bank panic we ever had. So that is why they did quantitative easing, to get the main threat out of the financial system and replace it with good cold hard cash. Now, so whereas they may paint the pretty picture of it was just to get the economy going and it was a really hard recession, we really want to get, the real reason for quantitative easing was like Jesus Christ, I like to call it, oh, Janet the Yellen of the Fed, who taketh away the sin of the banking industry, print off more money. Christ the Lamb of God taketh away the sin of the world. Do you guys ever go to Sunday school? Bonus points if anyone knows where that movie's from. That's essentially what the Federal Reserve did. It bailed out all the sins and the stupid fucktarded mistakes of the banking class. And I have a book called, I'll show it to you. It's a great book. I mean, this you'd understand it from the ground up. Aaron, you always try and plug your books every chance you get. You damn fucking right I do, and at least I'm more honest than the bankers. This right here explains what was going on. Behind the Housing Crash. Great book. Wonderful book. Anyway, that's what the Federal Reserve was doing. Is basically, Jesus, the concept of Jesus is he took all the sins of the world and he paid for it, and so that everybody else could go and continue fucking up their lives, basically. And that's what the Federal Reserve did. It took all the sins, all the bad loans of the entire financial industry, took it upon itself, and made it so that everyone else would, quote, be sin-free and could continue on with their lives while the Fed would take the hit. And I will stop here, and I'm going to show you a little chart, and you can see it on the balance sheet, so give me a sec here.
I apologize, I'd actually filmed this. I tried to do the software where it just screen captures your screen, but Cam Studio sucks. So anyway, here's the Federal Reserve balance sheet, and you can see this kind of Jesus Christ taking away the sins of the world aspect of the Federal Reserve. It's the Federal Reserve balance sheet. And for the most part, before the financial crisis, this is what we'd expect. The majority of the balance sheet of the Federal Reserve's assets are T-bills, federal government notes. Those are the kind of blue and red, and then some minor other issues of gold and other type assets. Then the financial crisis hits, and bam, you could see it no longer is a central bank. What it is just a bailout mechanism. And all this right here is just crap and shit. All the worthless shit that were on the bank's books, the financial industry's books. And you can kind of see if you look at the details. Oh, this big orange thing, that's, where is that? That's mortgage-backed securities. There it is. There's some other bailout mechanisms that they have. And even here, this red, even though that you get, this isn't even to be Republican or Democrat. This is Obama shit right here. All this spending, that's your federal government debt. And the reason the Federal Reserve is buying the federal government debt, remember, they're two separate things, because nobody wanted to fucking buy it. No one wanted to lend the U.S. government money. So it's not only is this the sins of the banking industry, this is the sins of basically the social welfare class and the political class bribing and buying votes with people. So that's how the Federal Reserve, and you basically see it's just bailing out Americans. Bankers scum up here, and then welfare, scum down here.
Yes, I did not continue filming from the previous day. I have changed my clothes. So, anyway, to finalize and finish this off, has quantitative easing worked? And the answer, this is not opinion, just look at it. The answer is no. Now, some people may say, well, it staved off the financial crisis. Oh, yeah, but our economic growth has been piss poor shit ever since we've implemented the Federal Reserve quantitative easing, bailouts, TARP, and all that other stuff. GDP growth is I'd have to do the numbers again, but it's below 2% or around 2%. Heck, the last quarter was 0.2%. And we can largely conclude based on the Obama administration. This is not to pick on Obama. This is because at times, more or less, when Obama was elected is when quantitative easing started. It's been one of the lowest economic growth presidencies there has been. And to address the economic philosophy or the mechanics of, well, why has quantitative easing failed? Well, my opinion that monetary policy has no effect on economic growth. If anything, unless you're trying to keep the currency in line with economic growth, monetary policy can only harm and distort economic growth. But there are two main reasons why the government coming in, Federal Reserve coming in, bailing out the banks, being Jesus Christ, taketh away the sins of the banking financial industry, why this has not worked. And there's two reasons. But they culminate into one, and that is a lack of faith in the future. And this is where psychology meets economics, and where most economists stop and don't go that extra step to become really good economists. In order to have the economy grow, you have to have faith in the future. And you personally don't, but the people who matter in the economy do. And that is the workers, producers, innovators, and entrepreneurs. And there are two main reasons why there is no faith in the future. For those that matter, for those movers, shakers, and hustlers, the producers. One, you have a rapid and clear move to the left with the millennials, especially with the voting in of Obama as president and his re-election. It is very clear that the country and the democracy wants to be more parasitic, more lazy, more government bail me out, and we want other people's money. And let's be very clear, that's what it boils down to. I don't care about your claims of discrimination and privilege and it boils down to, in the eyes of the people that ultimately matter, that are going to get the economy moving, is you want more of their shit. You want them to be slaves for you more than they already are. You want their money, you want their wealth, you want their production. So that puts a brake and a great deterrent into people investing and growing businesses in the United States. The other factor is that the financial crisis not only really crippled Gen X in terms of like buying houses and consumer spending, but if you look at debt as a percentage, personal debt, household debt as a percentage of GDP, it has actually gone down. People remember it. There was a bitter taste left in people's minds about the financial crisis. And people became much more, not politically conservative, but fiscally conservative in their personal spending. So people are not buying houses. People are still trying to pay off their frickin' student loans. They don't have faith in the future. This is not 1950 where you get a job for 30 years. You could afford a 30-year mortgage. People, they remember the harsh times all of 4, 5, 6, 7 years ago. Not to mention, really has been great times since. So people are on the edge. They're on the verge. They are not going to go and blow money and piss it away like they did, partying like it's 1999. Prince reference for all you young kids out there. So with that financial crisis fresh in the memory of people's minds, and socialists manifested in the election of Barack Obama, scaring and deterring away investment, what has gone down is the velocity of money. So what's the velocity of money? Well, the velocity of money is kind of like more or less the faith people have in the future. So the velocity of money specifically is the rate at which a dollar bill is respent. So I go and buy an ice cream for $5. And that $5, the ice cream maker takes his $5 and he's like, oh, I'm going to go and buy some gas. If you don't have a lot of faith in the future of the economy, you're very reluctant to spend. And so what ends up happening is you maybe save that $5 instead of investing it or spending it. And you can see, look up the M2 money velocity. I'm not going to throw it up. Look it up at the Federal Reserve Fed database and the St. Louis Federal Reserve. It's the lowest it's ever been in recorded history. People simply don't have faith in the future economy. Either entrepreneurs and investors that would invest that money, or consumers who would go and buy things like cars and ice cream and all that other stuff. So the question then is, where does that money go? Because if we've done all this quantitative easing, we flooded the economy with money, where does the money go if we're not going to invest it? Because if we invested it, it would have shown up in GDP. GDP and economic growth would have gone up because we would have had investing in plants and equipment and business and hiring, and unemployment would be way lower than it is. Labor force participation would be much higher than it is. So where does the money go? The only place it can. Assets. You say, what do you mean assets? Well, I mean assets. Housing, property, real estate, stocks, more securities, investment securities, stocks, bonds, mutual funds. And that is why you see the stock market going up and housing prices going up, is because this money is flooding that market. Now, how does it get there? Well, it's again through quantitative easing and monetary policy. Interest rates are very, very low. And so corporations, one way that money ends up going, not investing in plants. You have to understand, this is not investing. This is merely creating property bubbles and asset bubbles and stock price bubbles. Interest rates are so low, corporations are looking and say, what? I get to pay 2 or 3%? And I could go and borrow at that, and inflation's 2%, so it's a 1% effective interest rate, and I could go and buy back all the shares of my corporation's stock, which will drive my stock options up and my personal holdings of this company's stocks up as well. So there has been hundreds of billions, I'd have to go and look up the figures, but I would almost dare to say more than $1 trillion worth of corporate buybacks have been occurring. So corporations will go and borrow money and buy back their shares. When you buy back their shares, that floods the stock market with money, drives stock prices up regardless of profits. This has nothing to do with the profitability of the firm. These are corporations changing their, quote, capital structures, where they swap in debt or equity for debt. So they're borrowing money, paying off equity. Stock prices go up. Corporate executives make more money. So there's that flow of cash in the stock market's driving up asset prices. Another thing, low interest rates, mortgages. All right, I know the housing bubble burst, but housing has been going up because interest rates are low and people can afford more housing than they used to with these very low interest rates. Have rents gone up? No. Have the real savings in rent, should you purchase a home, gone up? No. But since money is so cheap, we can go ahead and force housing, so the housing bubble is reinflated. And then finally, when the Federal Reserve buys the shitty assets off of bankster scum, financial institution, and banks, these banks have all this money. Well, no businesses are borrowing from them. No one's going to invest in a plant or start a company here in the United States, not with that fucking dipshit Obama you guys elected about. You didn't earn that, you didn't build that, fuck you. So what are these banks supposed to do with that money? Well, they'll buy back their own shares, but then they'll go ahead and invest in marketable securities, stocks, bonds, mutual funds, and all that. So more money is flooded into the stock market. So the only real effect that quantitative easing has had was to create asset bubbles, property bubbles, stock bubbles. That's all it really has done. Economic growth sure as fuck hasn't grown. You've deterred people. I know you let this, you think you know more an evil corporate. You go keep spewing, keep hating corporations, keep hating evil rich people. You go ahead and hate them. And then when there are no jobs and Medtronic leaves for Ireland and GE shields all their money offshore, as does Google, and you know that leftist socialist wonderful corporate social responsibility company called Apple you guys all jerk off to? Yeah, they ship all their money off overseas. When that happened, because you've essentially scared the capital away, it's called capital flight, investment flight. You've scared them away. There's no real investment. That money is going to go somewhere, and it goes into assets. Not producing. They are already buying assets. They're not creating new companies. They're not creating new plants. They're not creating new manufacturing or services or industries. It's simply going and being dumped into the financial markets and the housing markets and the property markets, driving property and asset and stock values up with no commensurate increase in profits and rents that we make it. So that is the net effect of quantitative easing. It is merely, it's very Austrian economics, if you want to look it up. They've predicted this long ago because it's common sense. It's not brilliance, it's not genius, it's just common sense. But quantitative easing, well intended as it may have been, naivete, I say, on my part, many other people would say malicious inflating of property bubbles for political purposes, which is also true. But it's a miserable failure. It is a miserable failure of Keynesian, modern-day, conventional, academian government economics. There is no economic growth. All we've done is made things more expensive, created inflation in the various asset markets, and that's it. That's quantitative easing. If anything, quantitative easing should be a testament or proof that the experts don't know what the hell they're talking about, and that largely the monetary economics profession is a joke. They may as well be looking into a crystal ball. It's no different than witch doctory, as far as I'm concerned. I even put together a post about how the economics profession has failed. It is proof positive that the experts and the authorities of economics, your government bureaucrats, your politicians, we're a Federal Reserve, they don't know what the fuck they're doing. They have failed. They've indebted us a lot more. Now we have 105% debt to GDP. We have deficits. Nobody who's younger should be investing in property or stocks because it's incredibly overinflated. We've priced out younger generations from any kind of genuine assets, and we've made assets so overvalued that the profits they generate are not worth purchasing. But you know what? We saved a bunch of banker scum. We saved a bunch of hedge fund assholes. We saved a bunch of inferior economists over at Goldman Sachs and bailed out a bunch of people. And we kept that financial system going. For what point and purpose, I don't know, because the economy isn't growing, the real economy. But that's it. That's quantitative easing. So I wish it was more optimistic. But you know what? You guys keep voting in Democrats. You keep voting in socialists. You keep listening to your Keynesian professors in economics, and maybe, not this generation, but maybe down the road when your kids' generation are still living with you when they're 40 or 45, because the economy never grew, despite, quote, experts, top men. Free beer for anyone that can get that. That's too easy. Oh, top men. Because we have top men. You realize these top men, they don't know what the fuck they're talking about. So anyway, I hope I kind of explained quantitative easing to the non-economist. Perhaps I even explained quantitative easing to you professional economists who still have your heads up your Keynesian ass because you actually never had an independent thought. You just actually swallowed it whole. But yeah, that's quantitative easing. So I hope that helped everybody understand what it really is. And if you were be so kind as to visit my other websites, I have a podcast called The Clary Podcast. You can search that on the internet. Go to my website, captaincapitalism.blogspot.com. And if you, as always, have a video request or have some kind of need for guidance, consultation, or wisdom, you can go to Asshole Consulting, where I'll put together your very own little video like this. Or if it's of a more private nature, I will, of course, just email you. Anyway, best of luck. Hope you had a good economics lesson. Toodle.